Another day, another wild session on Wall Street, this time to the downside. Unfortunately, the selling was aggressive enough where we did see our postures from an intermediate perspective go back to bearish after such a impressive day to the upside yesterday. So a little bit more whipsaw type of action we've been experiencing here recently. So we'll take a look at all of that. We'll then get into our trade application example where I wanted to focus on one of those indices that's getting beaten up the most and focus on a bearish trade on that particular index. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 2nd, 2021. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe. While you're there, go down to the description area and sign up for our email distribution list. We're also heavy users of Twitter. I would encourage you to follow me at Brandon Van Zee, and we appreciate those of you that click like and retweet on these Market Outlook related tweets. Last but not least, we have a presence on Facebook. Feel free to join our group at the web address you see in the logo in front of you. All right, let's jump into our trading activity today. And while we had a pretty decent size sell-off in a few of the indices, the S&P 500 was down slightly less than 1%. So I'm not going to start with that other chart that sometimes I do when we have a sell-off day. This one wasn't quite a 1% day for the S&P 500. It was down 0.81%, but the NASDAQ composite was down more than 1%. It was down 1.69%, and the Russell 2000 was down 1.93%. So both of those two areas got hit a little bit more. Keep in mind, they usually attract a little bit more speculative activity. Small caps are known as being a little bit more speculative, and the NASDAQ, of course, is technology heavy, and so you do have a little bit more violent moves on occasion. Now remember, that can work to the upside as well, which is why we've seen the NASDAQ outperform as well as it has over the years, but it can hurt a little bit more on the downside as well compared to some of those bigger indices out there. Something like the Dow Jones Industrial Average, it covers the 30 of the largest companies in the United States, and so you don't see as much aggressive selling and buying in that particular index traditionally. It was only down 0.46% today, by the way. So as we kind of look at the damage after today, and again, what makes it somewhat noteworthy is it looked pretty positive yesterday, right? We had these really solid up candles, some of the best days we've seen in about 9 months, and so this is not a very strong sign to see one day later giving back most, if not all, of those particular gains. In fact, for the NASDAQ, it was particularly bad. You can see here that yesterday's move pushed us right up to that moving average. Now, those of you that watched this presentation on Thursday when I did it last week heard me mention that it's starting to become more concerning with the NASDAQ because we're spending more time below the 30-day moving average, and my fear was that if it went up to the moving average, it might very well start using that as resistance. Well, lo and behold, that's exactly what unfolded here. We went right up to that 30-day moving average yesterday on that big move higher, and then today we clearly rejected that moving average. Now, the moving average itself is still tracking higher. That's why it's kind of that yellowish color there. Remember, it will turn red if the moving average starts falling, in addition to having the price below that moving average. So that's the next thing we're kind of looking for here, and it's becoming a bit more concerning here, quite frankly. And the reason for that is you'll notice that the NASDAQ is actually starting to print these strongly bearish postures here. They're not just weakly bearish anymore. The difference there can be seen visually by using that darker shade of pink like we do on the chart right there compared to what you see up above on the S&P 500, the Dow Jones Industrial Average, and the Russell 2000. All three of those are that lighter shade of pink right now, telling us that we have weakly bearish postures. This darker shade of pink right here for the NASDAQ composite suggests that we have a strongly bearish posture. And remember, how we distinguish that is where is the green line placed within the market forecast technical indicator that you find on the Thinkorswim platform. With the NASDAQ composite, you'll notice that the green line is at 34 and falling. Remember, once it goes below 50th percentile on that indicator and it continues to fall, we would then have that strongly bearish posture. Whereas with the other indices, yes, the lines are falling, the green lines are falling, but they're still above 50 at this point. It's at 67 for the S&P 500, it's at 73 for the Dow Jones Industrial Average, and it's at 68 there for the Russell 2000. You'll also notice that those three share a common element, which is they are all still trading above rising moving averages. And again, that's where the NASDAQ stands out, in this case more bearishly. It's not above its moving average, it's below it. And it just gives you the impression that there's a baton pass that's taking place here. And of course, we've talked about it for quite some time at this point. This should not be new information. Last week I mentioned how the momentum factor fell from second best to second worst, and it continued to maintain that second worst placement when I just ran the numbers here a moment ago. We'll talk more about that tomorrow morning in my factor-based swing trading class. So that was one indication. I also showed you those ratio charts last week and how we were recognizing this baton pass between value and growth. So there's been signs that this kind of this mini meltdown in these technology-oriented stocks could occur. So it's not completely out of the blue here. So we want to keep our eye on it. One other thing that I'll just mention is that Zoom Video has been one of the kind of superstar stocks over the last year. And it really came into its own as a result of the coronavirus and how it forced a lot of folks to kind of stay at home to work, and that required some creative workarounds when it comes to getting their typical jobs done. And so a lot of folks now using Zoom Video, and that includes classrooms and nonprofits and things like that as well. So Zoom Video has kind of been known as one of the poster children of the coronavirus era. And things started looking quite good for Zoom Video today, and that's why it was so disappointing to see how it ended. So if I were to pull up, let's just do a chart 3A here real quick, and the ticker symbol for Zoom is ticker symbol ZM. And you can see that after they reported their earnings yesterday, it looked like this stock was going to really take off. I mean, the stock was, I think yesterday afternoon in the after-hour session, it was trading up here at $450 per share. And that was after the stock had already gone up dramatically, gapped higher yesterday in the normal session. It was gapping higher yet again in the after-hour session. Well, you can see how things ended up shaking out for this one. It started high and it ended low. That's what that really nasty candle right there looks like. That's one of the worst looking candles you'll ever find, where you have that type of behavior, where people were highly enthusiastic initially to gap the stock up, and basically the opening print was pretty much the high of the day. You can see right up here, I know it's hard for you guys that are on your cell phones, but I'll kind of read the numbers out. But above the chart, there's an O for open, and then there's an H for high. And when I point at that candle, the O says 439, and the high was 440. So in other words, you were basically just $1 away from the high when you gapped up to start the day. That was as good as it got. And every single tick lower throughout the day led you to an awful result at the end. The stock was down 9% here today. Obviously, an ugly, bearish, engulfing candle right there, in addition to now supporting a falling 30-day moving average. So that was a big disappointment. Zoom is an important company to the NASDAQ these days. Zoom is like a $100 billion company out of nowhere over the last year. And so when you see kind of a leader like this taken out back and shot, it doesn't usually portend good things for the index itself. So the NASDAQ certainly did suffer more than those other areas here today. Let's look at another chart. In this case, let's go over to the 3 green arrows chart. And this will be chart 4D. And as we're looking at these charts here, a reminder that this particular chart setup will have a slightly different policy when it comes to the background color. The background color will be either green, red, or white, or empty, however you want to say that. And so 3 out of our 4 charts are empty right now. This one up here with the S&P 500, Dow Jones, and the Russell 2000. Those are the 3, remember, that were the weekly bearish posture on the market forecast view. So the only one that's the exception to that is the NASDAQ composite. you can see that it has this light pink background color here, suggesting we now have a 3 red arrows signal on the NASDAQ composite. We've still got the red arrow in place from moving below the 30-day moving average here back on the 25th of February. We still have the red arrow in place regarding the loss of momentum that dates back to February 17th. And today we received what's known as a phantom red arrow on the stochastics, telling us that price is more apt to be closing near the lows of its various previous ranges than its highs, which is generally perceived bearishly. So we now have that pink background color telling us that we do have a 3 red arrow signal on the NASDAQ composite. That, in addition to what we just saw a moment ago, where the NASDAQ composite is the only one to have a strongly bearish intermediate posture, according to the market forecast technical indicator, should be part of this pattern that you are recognizing. We are seeing some aggressive selling in some of those technology-oriented areas that fared so well in 2020. This is a different type of a market, like I've been sharing with my students in my top-down trend trading class, where we've got to get used to this idea that the banks and the oil companies are legitimately leaders here, and it feels uncomfortable for a lot of people to just say that out loud because they've been burned doing so many times in the past, but it is the truth. Those areas are attracting much more investor attention right now than some of those high-flying tech stocks that excelled so well last year when everybody was locked down in their homes and using technology a bit more. As we start reopening the economy a bit more going forward here, the expectation from the stock market's perspective is that some of these areas that had been left for dead are going to be those areas that gather a little bit more positive momentum on a relative basis. And we'll see where that takes us. Now, obviously, the NASDAQ has a lot of different types of companies in it, so I'm kind of generalizing there when I'm talking about tech stocks, but they are the more dominant area of that index, and so there is a specific reason why we are seeing it getting beaten up a little bit more than when we're looking at some of these other indices here. All right, let's go ahead and pop on over to the internet here briefly. I always like to get an opportunity to say thank you to those of you that help support this project that David and I have. Remember, doing these videos is not a requirement of ours. We do it on a volunteer basis. Those of you that are premium members, we certainly appreciate you, and that's why we always commit to getting our trading rooms. We teach 10 classes for our premium members each week. We commit to getting those done regularly, but these are more promotional and volunteer basis when we're doing these YouTube videos here. And while we enjoy doing them, we also need to be incentivized to do them. In other words, we've got a lot of things going on as business owners, and to chew up a couple of hours of our day recording these videos, doing the edits, and sending out the notifications, and doing all that kind of stuff, you gotta make sure that we're spending our time wisely. So what I try to set forth to do is to achieve at least 100 likes on Twitter. If I'm getting at least 100 people saying that they appreciate the effort that goes into this and want to help support the project, then I have no problem continuing to do it. So you guys have done a great job stepping up to the plate for me there. 116 of you did that for me the last time around. Keep up the great work there. Only takes 5 seconds for you to do that, by the way. Another thing that I wanted to point out is I needed to make a couple of updates. We had a couple of class changes, time changes here to our normal schedule. So I needed to go back and update our welcome area of our website. A lot of times people don't know where that is on our website because it's given to somebody when they first subscribe to our premium services. I'm merely pointing this out right now. Not that it's overly important, but since I was updating and it was fresh on my mind, I just thought I would let those of you that are premium members know about it already. And so I did post the link to this in my Telegram channel, the same place where we post our trade alerts for those of you that are premium members that want to check out this area. It does include a lot of helpful links, and most of you are aware of this. This is more for somebody that would be brand new to our offerings, but some of you that are maybe trying to get re-engaged with your education, maybe you've kind of been away for a few months or what have you, some of this information might be helpful to you as well. So you can see the web address up here. It's just marketscholars.com/welcome-to-market-scholars- YPR. And if I read that off too fast, again, check the Telegram channel, and you'll find it there. The other thing that I'd point out is the sector selector, which I put together on Friday afternoon. And we've got a little bit of new information, but not a whole lot. Remember, this gets updated on a week-by-week basis here, so that way we can kind of track the transitions that are taking place. And as I mentioned just a moment ago, energy and financials are the areas that are gathering momentum on a relative basis. Energy is back up to the number one slot. We do have communications dropping slightly. Then financials did rise up to the third slot there, and then discretionary kind of fell into the fourth slot. All the other rankings were exactly the same as the week before, so not a whole lot to discuss there, just a little bit of rearranging up at the top of the deck there, with energy back in the top slot for the first time since late January, though. But remember, we went years with having energy in the bottom portion of this ranking when I've been sharing it with you. In fact, there were stretches of time for multiple months where it was dead last. It couldn't even get to second to last. So this is kind of different behavior out of oil and gas companies where we're at right now. They have been more consistently strong for a longer period of time, which suggests this is not just some sort of a dead cat bounce that we're dealing with here. There's a more legitimate effort to get money transitioned into the oil and gas companies here again. So keep your eye on that area, and it's certainly an area that we've been talking about quite a bit here in my Monday top-down trend trading class over the last couple of months. So if you're interested in that, make sure you check out those recordings there. Earlier today, I did teach my dividend growth investing class. We did have the first half of the class dedicated to my interpretation of the Warren Buffett shareholders letter that was issued over the weekend. So if you're a premium or plus member and want to hear my thoughts on that very popular value investing letter that comes out once a year, feel free to check out the recording. It is posted up here in our trading rooms area and available for you to watch whenever you want. And then David taught his directional option strategy class earlier today. Tomorrow morning, I'll be back in the saddle with factor-based swing trading, and we've been on a heck of a win streak in that swing trading class, and I hope we can continue it. Feel free to join me if you're one of our premium members. All right, let's get back on track here with some more charts. Let's go ahead and start doing some 12 grid analysis now. And I'm going to pop on over here to chart 5A, which will be our asset class 12 grid. Reminder that the background colors of these 12 grid charts are going to tell us whether we have a bullish or bearish current intermediate posture. So in other words, it's not going to flip-flop the colors on the background the way that some of our bigger charts do. They're just, we'd have to squint too much to be able to see that on these miniaturized charts right here. So just to make it easier on our eyes, whatever the current posture is will determine whether we have a pink or a green background color. So let's get into the information and see what we can learn. First of all, one of the big stories that we've been dealing with here recently has been the 10-year U.S. Treasury yield and interest rates in general. That's been one of the big drivers of market activity here recently. We had this huge spike in rates that kind of finally started to run out of steam a little bit there late last week on the 25th. We've actually pulled back in interest rates here for the last 3 sessions, and that means that bonds have been able to kind of stabilize in price a little bit as well. You can see we have had a little bit of a pop higher here in bonds. And we shouldn't be overly surprised to see that, right? We've been talking about this concept where bonds have been so oversold. We've been receiving these oversold cluster signals here. And so we should all be expecting a reversion to the mean type of a move. What has been abnormal is how there just hasn't been any sort of a real effort to push bonds higher in the short term whatsoever. Even the slight reversion to the mean move we got right there at the beginning of February for 3 days didn't really amount to much, and then it rolled over yet again. So we're getting one of these reversion to the mean moves right now, but I'm only going to believe a reversal when I see it. In other words, if we get some sort of a pop higher here and we start seeing TLT get closer to that moving average again, you're probably going to find me doing another bear call spread on it like I did at the beginning of the year. Right now I'm kind of in wait and see mode because I kind of interpret this as we're in a little bit of an oversold territory here, although longer term, I dislike the bond market. In fact, that was a big topic of our conversation today in my class when we were interpreting the Warren Buffett letter, for those of you that want to check out that class recording there. So I kind of agree with Buffett that those that own fixed income assets are going to struggle on a relative basis in the years to come, but that doesn't mean that that's going to happen every single week along the way, right? You're going to have weeks where you have a pop against your trade. And so I'm kind of waiting for one of those moments in TLT. If we get it and we get a good setup, then I'll probably look to reinitiate another bearish trade on the bond market. Another area that we've been kind of trying to focus our attention on has been the US dollar. Hasn't been nearly as exciting as what we've seen out of the interest rate environment. You can see the US dollar has kind of been chopping and slopping sideways. It hasn't seen a consistent direction. Today was one of those sell-off days for the US dollar. We were down 0.37%, which is actually a pretty decent sized day for a big currency like that. That likely allowed some of this gold to shine a bit here. Although, again, kind of the same comment that I would have with long-term treasuries. This is a bit of a whimper right here. If this is all that gold's got, there's a trouble brewing there. This is another chart that has been sold off fairly aggressively to the point where we've received oversold cluster signals here. Now, unlike bonds, I actually have some interest in gold for the longer term, but I just don't know if this is the time for that or not. We've seen really aggressive downside activity for gold, so you'd probably want to wait for some sort of established support before getting too aggressive to the long side of the gold market. And this is not a great sign. We've had some really ugly selling action here in gold in the last week or so, and while we were up today, that's only 0.5% a move. On a day when the dollar fell dramatically, it's giving gold an excuse to go up dramatically, particularly combined with the oversold cluster signals. So while it was up, and it might make some folks a little bit happy, that's not the type of move you would expect right here. So that whimper is a little bit concerning there out of gold. With oil, you'll see oil was down today. It's performing more like a kind of a risk asset, more so than a pure commodity these days. With risk assets selling off today, oil did sell off a little bit as well. However, unlike the NASDAQ composite chart, which is another way to kind of judge risk appetite, I'm much more favorable towards the oil chart. Yes, we've been down 4 days in a row here, but notice the background color stayed green despite that 4-day sell-off. You don't see that a whole lot. So it just goes to show that this stock's intermediate trend was so cemented in place that even a 4-day losing streak is not enough to knock it off course. So I think there's an interesting opportunity here in oil. It'll eventually stabilize itself here, and if it does so above this rising 30-day moving average, I think there's an opportunity for bullish trades on oil at that moment, bullish bounce trades. So we'll be looking for those. Perhaps we'll start seeing them as soon as tomorrow morning in my factor-based swing trading class, where we do focus on those bounce swing trade opportunities. So keep your eye on oil. Yes, it was a little bit of an aggressive sell-off here today, but I don't think the story's done with oil. We still have some room to make our way to the upside in that particular asset class. You'll notice here that when we look at some of the foreign markets out there, foreign stocks from the developed perspective were down today. However, they did outperform the United States. EFA was only down 0.11%. On the other hand, emerging markets were down nearly 1%. So they were down a little bit worse than what we saw in the United States. Remember, of the two, the one that's a little bit more surprising to me would be emerging markets. The reason I say that is with the US dollar here falling today, you would expect foreign stocks to outperform US stocks. So EFA did what it was expected to do. EEM did not necessarily do that. And EEM's chart is also concerning me, similar to my thoughts on the NASDAQ chart, which is we had this beautiful uptrend that was in place, and it just got ripped away from us in a very short amount of time. So there's a little bit of chaos in the charts right here. And the concern is that as we've been trying to work our way back up to the moving average, it doesn't look like it has the oomph to do it, right? We had this big candle up move yesterday on EEM, and today we immediately rolled over yet again. So notice how this moving average itself is flatlining. And again, my concern is that it could very well represent some sort of a resistance point for emerging markets. You will notice that this candle here a couple of days ago was very similarly placed to this candle back on January 29th. So another possibility you have to kind of be on the lookout for is a potential head and shoulders pattern. Can't say that that's going to form yet, and that's why we got to look at these charts on a day-by-day basis, but the potential is there. And remember, a head and shoulders pattern in this particular sense would be a bearish reversal pattern. So not necessarily a great thing there if you want to be bullish on the market. So let's keep our eyes on EEM there as well. Bitcoin didn't do a whole lot today. It was down 2%, but for Bitcoin, that's a pretty quiet day, right? Unlike other asset classes, Bitcoin moves in big swaths up and down. So yeah, it was down today. We're in kind of a peculiar place here with Bitcoin where obviously the path of least resistance is to the upside. At least that's what the 30-day moving average is telling us. But from a posture setting mechanism perspective, we do have a weekly bearish posture according to the market forecast technical indicator on Bitcoin right now. All right, let's go ahead and take a look at another 12 grid. In this case, we're going to take a look at the sectors and see if there's any green that we need to be aware of. There's actually more green than I was expecting to pull this up here today. Yesterday's big rally did help a few of those areas. We've got kind of a mixed bag. And so as we look at this, we have a lot of our pink charts towards the bottom, a lot of our green charts up there towards the top. The pink charts on the bottom have been fairly commonplace. We've been having this discussion with you guys for quite some time, probably more than a month at this point. So that is not entirely surprising. It's been more of an interest rate story where a lot of those dividend-paying entities like your utilities and staples and what have you struggle on a relative basis when interest rates go higher. So that part of it is not all that surprising to me. One thing that's a little bit more concerning here, though, is what we're seeing out of the discretionary stocks. Consumer discretionary was one of those areas that we felt like we could count on for a while. It was an area that was doing quite well and is known as a place where you can take that temperature of risk once again. And so we are seeing a steady rolling over here of discretionary. Part of it might be Tesla. Tesla's stock looks like this. So it's no surprise that when you look at XLY, it looks like this, nearly an exact replica of it. Remember all of the hubbub late last year when Tesla was added to the S&P 500 and how the S&P 500 had to do a major amount of buying to put Tesla into the index. Typically, when you add a new company to the S&P 500, it's a much smaller entity. It's not a big deal. Tesla had grown to this massive organization, one of the top 10 largest companies in the United States, and then got added to the S&P 500. Well, remember that same effect can take place with these underlying sectors as well. XLY is an ETF that tracks only the consumer discretionary stocks within the S&P 500. And since Tesla is so gigantic, it is highly, highly influential in this market cap weighted version of the discretionary sector right here. So I don't know if we can read too much into that. There are some areas of discretionary that still look reasonably good. We talked about Ralph Lauren here in my class a couple of days ago as just one simple example, but some of those clothing retailers are holding up a little bit better, but it's kind of being masked right now because Tesla is such a heavy weighting within the consumer discretionary area that it's just kind of overwhelming everything else that might be doing good within it. So I think that's the story there, and that's not necessarily a great sign. You know, when markets were bullish and Tesla was bullish, you kind of felt like the path of least resistance was to the upside. Now that Tesla and Apple and some of these key leaders are kind of rolling over, it doesn't give you as strong of an impression about the market right now compared to where we were at maybe a month or so ago. In terms of the areas that continue to work, I mentioned them before, but here is energy. It was down today, but not by much. Obviously, still up here closer to its multi-month highs, and you can make the same claim there for financials. Down a little bit today, but still near multi-month highs. Those are your two kind of leadership areas right now. Communications is also hanging in there there pretty well, but technology is showing some more wear and tear that we want to keep our eyes on here. So the fear would be if technology would go the same way as discretionary. And if that's the case, we're going to see a lot of our leaders go down at that point, right? It's Apple and Microsoft and all those types of companies within technology. That would not be a good thing for the bullish sentiment on Wall Street if they started rolling over in a big way. So we're going to keep our eye on that story. Not necessarily a great sign here that we had this bearish engulfing candle on technology and we're back trading below the moving average again. So it's not a major broken support to where we were at a week and a half ago, but it is still noteworthy considering how quickly we went up yesterday and then gave all of it right back here today for the most part. All right, let's get into our trade application example. It was a pretty simple one for us here today. I'm just going to pull up chart 4A, and a reminder that the trade's already been done. It was done about a half an hour before the market closed or somewhere thereabouts, and I always send out the trade details and the screenshots and all that kind of stuff to all of our premium members on our Telegram channel. So it gives you guys some incentive in terms of information to you sooner than everybody else that might receive it on the free YouTube video later that night. And in this case, that really worked out because this was a day where I did a bearish trade and the market kept on falling into the close. So we're already up a little bit on that trade. But we'll see where tomorrow morning takes us. So what I'm going to do here is just sort of pull up chart 4A, and we're going to use QQQ as our example here. All I did was I sold a bear call spread on QQQ. I did the April contracts, if my memory serves me correctly, and I think the sold call was at 339. Which was slightly higher than where the high was for QQQ here on February 16th. So in other words, what I'm doing here is I'm hoping that QQQ does not achieve a new high by the middle of April. If it doesn't, then I'm going to win that trade. And that would be the case even if QQQ does go up. It just doesn't go up and achieve a new high on that expiration date. So it's one of those more moderate types of trades. It's not an aggressively bearish trade, but it is a bearish trade, and that is somewhat noteworthy. Most of you know that I haven't done any stock bearish trades, or in this case, index bearish trades in 2021. So I kind of view this as not necessarily some big statement that, hey, we need to be aggressively bearish here, more along the lines of just recognizing there is wear and tear on the charts right now, and we have a lot of bullish positions that we've already done, and so this could be, just balancing the portfolio a little bit more there. So just going to ease our way into it and see how it goes. And if the markets continue to to start suffering to the downside, I won't be afraid to put on more bearish trades. But right now, just kind of a starter position there as a bear call spread on QQQ. And again, if you need the details on the specific strikes and the execution prices and all that, if you're a premium member, check out our Telegram app there. But obviously, all the same things that I said earlier in the presentation hold true and were the motivation behind doing a trade like that, which is, in this case, QQQ seems to be acting worse than the other three indices that are out there. It is the one that has the strongly bearish intermediate posture. It's the one that has 3 red arrows right now. It gave us kind of this ugly bearish engulfing candle here after what appeared to be a pretty positive day yesterday. And it just gives me the impression that it's struggling to get up and over its 30-day moving average. And so the fear would be where it used to use the 30-day moving average as support, it might very well start using it as resistance for this period of time that we have in front of us right now. Okay, so that's what I had for you. Hope you appreciated the analysis there. If you did, I ask one simple favor out of you. Just take 5 seconds out of your day and click like for me there on Twitter. Many of you can do it while you're watching it either directly on YouTube or on our website. Or if you're on Twitter a lot, you can always just go to my profile and it'll be pinned to the top of my timeline there. So I want to thank you for your attention here this evening. Pretty rough day in the market, specifically for those technology-oriented areas, but we'll see where it takes us. And obviously looking forward to seeing many of you in class tomorrow morning. And then David should be back with you on the market outlook tomorrow afternoon. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.